Welcome to Chapter 2. In this chapter, we're going to take a further look at financial statements and see what the purposes of these financial statements and how they are used in a business. The learning objectives for this chapter are to identify the various sections of a classified balance sheet, to use ratios to evaluate a company's profitability, liquidity, and solvency, and to discuss some financial reporting concepts. This third objective is covered in a different video. We're just going to focus on the first two learning objectives right now. So to recap, in a financial statement, you have four major statements: an income statement, statement of retained earnings, balance sheet, and statement of cash flow. We are now looking at a balance sheet. A balance sheet presents a snapshot at a point in time. To improve understanding the company, what they do is they will group similar assets and similar liabilities, and that is going to enhance our understanding of the company's performance. So the first classification under assets would be current assets. And here what you're really looking at is all those assets that will convert to cash, and we expect to get the benefit out of them within 1 year or the operating cycle, whichever is longer. So 1 year is fairly easy to understand. We're looking at 12 consecutive months. Operating cycle is the average time it takes from the time a company purchases inventory, sells it, and collects cash from their customers. So let's take a look at a couple different examples. If you look at a dollar store, they purchase a merchandise, they bring it into the stores, they sell it, and in case of a retail business, cash comes in immediately. Whether it's a cash transaction or a credit card transaction, it's cash for the business. The operating cycle typically for a dollar store is less than a week, which means they have to move their merchandise on a weekly basis in order to stay in business. Now let's look at another example, a jewelry store in a mall. They buy their merchandise, which is the various jewelry items, and they sell these items. How long does it take for an item to sell in a jewelry store? It could take weeks, it could take months for the inventory to move. So for them, their operating cycle is going to be much longer, but usually it is still within 1 year. They typically move their merchandise in 1 year's time. If you look at another type of business, a vineyard, they grow grapes. Once the grapes are grown, they pluck the grapes from the tree, they make the wine, and then they have to age the wine. So from the time they have purchased their inventory to the time they sell it to their customers and collect cash, that could take 3 or 4 years. So the operating cycle is much longer. So operating cycle depends on what type of business we're looking at. For the most part, whatever we work on in this semester, we always are looking at an operating cycle which is going to be within 1 year. So what are some of the current assets a company could have? They could have cash, obviously. Short-term investments, which means they've invested in stocks and bonds of another company, but it's for the short term. They're not going to hang on to it for very long. Accounts receivable, this is they've sold something on credit to a customer and they're expecting to collect cash from the customer very soon, typically 30 to 90 days. Inventories are all those items that they have purchased with the intention of reselling it. And as I mentioned earlier, companies typically want to sell it very quickly and not hang on to it for too long. And this last one, prepaid expenses. A good example would be insurance. We pay for, let's say, 6 months of insurance at a time. I'm not going to get the cash from it, but I'm going to get the benefit. So what's the benefit? I have the coverage in case something goes wrong. Then the insurance is going to cover me. So this prepaid expenses typically never converts to cash, but I get the benefit from it within the next 1 year. In the balance sheet, this is how you would list the items out. Current assets, you would list each of them and then write total current assets. Typically in this country, we list our current assets in the order of liquidity, which means how quickly they can convert to cash with little to no risk. So obviously cash and cash equivalents are listed first, and you go down the list and then you see the last item, prepaid expense, in that group, and that's never really going to convert to cash. Now let's take a look at long-term investments. This is when a company invests in stocks and bonds of another company and typically does not intend to sell it within the next 1 year. They do not intend to sell it, and they have the ability to hold it, which means they don't need that money. They can leave it sitting over there. Some long-term assets can be classified as long-term investment if it's not used in the operating activities of the business. So a company may have purchased extra land, and this is a very common thing that companies will do. They will buy land next to them where they are simply because they want to control who comes next to them. Or perhaps they're going to expand their operations in the future, and that's why they have that land over there sitting right next to them. That's not currently being used, so that's called an investment. And also if there are long-term notes receivable. Long-term notes receivable simply means if you have, typically the way it would arise is if you have given credit to your customer, which means you've told them they have an extended period of time to make the payment, or if this customer is a good customer and for some reason is unable to make the payment on time, you switch it from an accounts receivable to a notes receivable, granting them more time. And that would be considered a long-term investment because now on a notes receivable, they're going to pay me interest. On accounts receivable, you don't pay interest. You don't receive interest. Now the next classification under assets is property, plant, and equipment. Some other names used are fixed assets, plant assets. That could vary by company what they call it. So what are some of the unique characteristics of property, plant, and equipment? The very first one is the life of the asset is longer than 1 year, which means I'm going to use it for more than 1 year in the business. They're used in the operations of the business, which means they're going to help me generate revenues. Directly or indirectly, they're going to help me generate revenues. So what are some of your quick examples? Land, building, equipment, all of these examples that a company would typically have and classify as property, plant, and equipment. Something else that's unique about property, plant, and equipment, except for land, all the other items have a limited life. When you buy them, you book them or you record the journal entry calling it an asset, and then you spread the cost of the asset over its useful life. That process of spreading the cost is called depreciation. So the word allocation is nothing but spreading. You're spreading the cost. In a subsequent chapter, we're going to go through various methods of depreciation. Accumulated depreciation basically tells you how much you have depreciated the assets so far. Now, there could be another group of assets a company has, and these are intangible assets. These intangible assets, they have no physical presence, but they are created by the law. There is some law that has created this intangible asset, most of them, and this gives us some advantage in running our business and is going to help us generate revenues. So some examples are goodwill, patents, copyrights, trademarks, trade names. The list is quite long. Other than goodwill, all the others, there is a US government office where we put in an application, we acquire this asset. Let me rephrase it. We are granted this asset, the right to this asset when we apply to the government, or I could purchase it from someone else. So a good example would be copyrights. What type of assets, what could be copyrighted? Any intellectual or artistic work can be copyrighted. J.K. Rowling obviously has copyrighted all of her Harry Potter books, and the rights to the movies and everything, they all belong to J.K. Rowling. She is the creator. She is the artist who made it. Someone else can buy it from her, and then they can own the copyright. Once again, these assets are going to help you generate revenues. That's why it's called an asset. It's different from property, plant, and equipment because it doesn't have a physical presence. The creation of those assets is different. Now let's switch gears and look at liabilities. Liabilities, we have only two classifications: current liabilities, and the second classification is either called non-current or long-term liabilities. So corresponding to your current assets, current liabilities are any obligations that you're going to pay within the next 1 year or the operating cycle, whichever is longer. So all of these examples given over here, typically they're going to be paid in 30 days or less. Accounts payable is money I owe to my vendor. When Verizon sends me a bill, the due date is typically within 30 days. Salaries and wages payable, the due date typically is a couple days. The only reason I have a payable in the books is subsequently, you will see in a subsequent chapter that I create this account, salaries and wages payable, simply because of the timing of when I do my journal entry versus when I pay the employee. And typically that's just a few days at best. Notes payable, interest payable, income tax payable, all of these have to be paid definitely within 1 year, therefore they're the current liability. And also something unique about all of these is you typically have to pay it in cash. Also included are current portions of long-term obligations. So if I have a long-term liability, as long as it's a liability, I owe money. Now, right now, I may say that I owe the money 10 years from now. But when I get to the 9th year, that liability has become current. We'll take a look at current liability, some examples, and come back to this current portion of the current maturities of long-term obligations. So long-term liability is something that a company expects to pay after 1 year. They're not going to pay it now, they'll pay it out in the future. Bonds payable, typically a company borrows a large sum of money for a major investment. It's going to take them time to get the assets, put them to use, make money, etc. So typically bonds payable, the terms are anywhere from 10 years to 50 years, which means I borrow the money today and I say I will pay the principal amount 10 years from now or 50 years from now, whatever the terms and conditions are. In the meantime, I'm paying interest on a regular basis. Mortgage payable is a little different in that I don't wait. When you buy a house, you have a 30-year mortgage. You're not going to wait 30 years to make the payment. You pay it off in pieces throughout the 30 years. Typically on a monthly basis, you're going to make those payments. And that portion that's due next year, the next 12 payments that are due next year, that's called a current maturity of the long-term liability. Other examples are leases, pensions. Again, all of these are going to be met typically by, when I say they're going to be met, I mean they're going to be settled or paid off by way of giving cash. Stockholders' equity, in its simplest forms, has only two parts. The money invested by the stockholders, that's called common stock, and the money that the company has earned and retained in the business is called retained earnings. So there are two portions, what the common stockholder put into the business and then what the business has earned. The common stock number can never be a negative number because I'm giving money to the business. I'm the investor. I'm giving money to the business. That's always a positive number. Retained earnings can be a negative number. If that number is a negative number, it means I have retained losses in the business. And that is called a deficit. When you hear the word deficit in a business, it means retained earnings is negative. That's a huge red flag. I would bail. I wouldn't stay with that company. If I had invested in that company, I'd take my money out if I could. And if I work for that company, I probably would be looking for another job real soon. So now that we've seen how we group the various accounts within the balance sheet, and here's a quick example. You're seeing current assets, long-term investments, property, plant, equipment, intangibles. And then on the other side is your liabilities, current and long-term, and stockholders' equity. Now let's see what we're going to do with it. Someone has prepared these financials. They've given me the balance sheet. And I'm looking at these balance sheet. It's full of numbers. Numbers in itself don't really mean much. If I looked at the financial statements of a large Fortune 500 company, all of those numbers are in the millions or billions of dollars. They're very impressive, but that in itself is not really good. Let's see what we need to do. We're going to do something called ratio analysis, not just in this chapter, but throughout the semester, we'll be doing ratio analysis in every chapter. So what does it do? It's taking two or more items from the income statement and or balance sheet. And now we're going to just focus on the balance sheet. And we're going to try and come up with some kind of analysis. So what does the word ratio mean? It's simply a mathematical relationship between one quantity and another. So I'm going to look at two different numbers. I'm going to compare them in some way. I'm going to create a formula and then come up with an analysis. Again, a single ratio by itself is not going to be meaningful. Just like a single number that you see in a balance sheet is not meaningful. Okay, so what kind of ratio analysis would I like to do? I want to see how profitable the company is. I want to see how liquid the company is, which means they can meet their short-term obligations, and how solvent they are. Solvent means in the long run, are they going to stay in business? I'm not just concerned about here and now. I want to make sure that they're going to be around in the future. So here's a quick example. We have the revenues, expense in the income statement, and we're going to calculate what's called earnings per share, EPS, and this is a number that the stock market follows very closely. So what do we have in this formula? The net income number from the income statement minus any preferred dividends if there are preferred stockholders. Remember, I told you there's only common stock that we typically focus on. You could have preferred stockholders. If you do, then they are entitled to preferred dividends divided by weighted average common shares outstanding. So net income, we know this number, what it means. It's fairly easy. Revenues minus expenses, net income. I just explained to you what preferred dividends is. Shares outstanding, the number of shares outstanding, that could vary throughout the year. A company may issue more shares, they may buy back shares. So the weighted average is just taking the average, beginning number plus ending number divided by 2. So we have it for 2 years, 2014 and 2013. Remember, I want to compare these numbers. So for 2014, earnings per share, net income is 532, preferred dividends is 0. And then the weighted average shares outstanding will be calculated as these two numbers, beginning plus ending, divided by 2. That gives me earnings per share of $1.55. Now let's do the same for the next year, 2013. Okay. Now what do you see over here? In 2013, this first number is in parentheses. What does it mean? It's a loss. In the current year, they lost money. So on an average, the earnings per share is a negative number of $1.30. Now, 2013 to 2014, pretty dramatic. First of all, they moved from the negative to the positive. That's impressive in and of itself. And that number is more than doubled in terms of how it has moved. So this particular company has performed very, very impressively. And obviously, you need to go back and check in 2013, why did they have a net loss? Did they have a net loss in 2012 and 11 as well, or was that just 1 year in which something unusual happened and they suffered a loss? But I hope you get an idea as to how this particular ratio explains taking an income statement number, a number from the statement of retained earnings, and numbers from the balance sheet, and coming up with a ratio. Now let's take a look at liquidity ratios. The two major liquidity ratios we look at are working capital and current ratio. So liquidity is talking about nearness to cash. Are you able to pay your current liabilities? So working capital is the difference between the amount of the current asset and current liabilities. Now, this can be expressed, the same thing, current assets and current liabilities can be expressed as a ratio. In days gone by, this is many years ago, if you asked a financial analyst, what's a good current ratio? They used to say 2:1, which means for every $1 in liability, current liability, you should have $2 in current assets. Now, Best Buy has 1.41:1, and that number increased from the previous year, which obviously looks good. Now, if you compare it to H.H. Gregg, what was the number for H.H. Gregg? 1.68:1 compared to Best Buy's number. Industry average is 0.88:1. So this is all over the place in terms of trying to decide whether Best Buy is doing well or not. In recent years, if you asked analysts, they're going to tell you a 2:1 is overkill. You don't need to have that much locked up in current assets. And a lot of companies now actually aim to have close to 1:1 as a ratio. I personally would be a little nervous if a company has a 1:1 ratio. But if you look at the industry average, it's less than 1:1, which means they have 88 cents in current assets for every dollar in current liability. I'd have to wonder about some of these companies, how long they're going to stay in business. Now let's move on to long-term liabilities. Solvency, this is the ability to pay interest as it becomes due and to repay the balance of a debt due to its maturity. So remember, on your current liabilities, you typically do not pay interest. It's only on long-term liabilities you pay interest. So solvency is focusing on those long-term liabilities, basically saying, are you able to pay interest as time goes by? And when the due date comes, will you be able to pay that amount? So here you're looking at total liabilities divided by total assets. And the higher this ratio, in finance, they use the term leverage. They will say the company is highly leveraged. Okay. So basically, remember, in the balance sheet, as assets equals liabilities plus owner's equity. The closer the liability number gets to the asset number, it means there's less in equity. That could be good or bad. It could be good that you have fewer stockholders. They're using liabilities to run all the risk and run the business. And if it pays off, then they're going to get more dividends. And if it doesn't pay off, then they put less money in it. That's the typical argument used by people in finance, saying that a high debt to asset ratio means the company is highly leveraged, and that's good for business, good for the stockholders. I, again, would be a little conservative and say a number as high as 78%, or the industry average actually of 88%, is a very high number. I would not be comfortable at all. It means these companies have way too much debt in their books. Okay, now let's look at the statement of cash flow. In the statement of cash flow, we focus only on one category, the first one, operating activities. The net cash provided by the operating activities, hopefully that's a positive number. And I can also pay off some of my capital expenditures and dividends. Those two are, capital expenditure is an investing activity, dividends is financing activity. So basically, I'm saying from my current earnings, I can even pay from the current cash flows, the operating activities, I can even pay those other two for those other two activities. Whatever is left over is called free cash flow. Why is this important? This really is telling you how flexible a company is in order to meet some unexpected challenges. It could be an unexpected opportunity also. There's an unexpected opportunity that comes up. Can you act quickly and invest or buy, or whatever the case may be, the investment part? If you have to wait, remember again, in the statement of cash flow, operating, investing, financing. Financing, you borrow money or you raise capital through stockholders, you then invest. But instead of doing that, if you had free cash flow, you could take that and jump on the opportunity. This is why some companies will say that they really want to have cash available on hand so that they can do these kind of things and not wait to finance operations. Stock market is not in favor of that. They typically are a frown upon a company that has very large free cash flows. So what you have seen over here is that companies have various ways in which they can analyze their financial situation and do the best for their stockholders and for the company to stay in business.